Hello everyone. This video is AI generated and created purely for informational purposes. Welcome to Infotech Stocks channel. The year is coming to a close and the race for electric vehicle dominance is heating up. In a surprising move, both Tesla and BYD, two of the world's leading EV manufacturers, have announced significant discounts in the Chinese market. This aggressive strategy signals a fierce battle for market share as we head into 2025. The stakes are high and both companies are pulling out all the stops to entice Chinese consumers. This price war is not just about China. It reflects the growing global competition in the EV industry. Tesla and BYD are vying for leadership in the world's largest EV market, and their success in China could have ripple effects across the globe. The coming months will be crucial in determining the winners and losers of this price war. It remains to be seen how these discounts will impact Tesla and BYD's bottom lines, and whether they will be enough to sway Chinese consumers. One thing is for sure, the EV market is about to get a lot more interesting. Tesla, known for its premium pricing, has made an unexpected move by offering substantial discounts on its popular Model 3 and Model Y vehicles in China. These discounts come in the form of direct price reductions and attractive incentives, such as free insurance. For instance, the starting price of the Model 3 has been slashed by up to 13,000 yuan, which is approximately $1,800. Additionally, Tesla is offering insurance subsidies of up to 8,000 yuan for customers who opt for Tesla's in-house insurance plans. This strategic move is a clear indication of Tesla's intent to boost sales volumes in the face of increasing competition. The Chinese EV market is becoming increasingly crowded, with domestic players like BYD, NIO and XPeng gaining traction. Tesla's price cuts are a bold attempt to maintain its market share and fend off these rivals. However, this strategy comes with its own set of risks. Lowering prices could potentially impact Tesla's profit margins, which have been the envy of the automotive industry. Furthermore, it could also raise concerns among existing Tesla owners who purchased their vehicles at higher prices. It remains to be seen whether these discounts will be enough to sustain Tesla's dominance in the Chinese EV market. The company is betting big on its brand appeal and technological edge to justify the price cuts. Only time will tell if this gamble pays off. Not to be outdone, BYD, China's homegrown EV giant, has responded with its own set of aggressive discounts. Unlike Tesla, which has focused on specific models, BYD has implemented price reductions across its entire product lineup. Discounts vary depending on the model and trim level, but can reach up to tens of thousands of yuan. BYD's strategy is clearly aimed at leveraging its broad product portfolio to appeal to a wider range of consumers. The company offers a diverse range of EVs, from affordable compact cars to luxury SUVs, catering to various price points and customer preferences. By discounting its entire lineup, BYD aims to capture a larger share of the Chinese EV market. This move also highlights BYD's growing confidence in its cost competitiveness. As a leading battery manufacturer, BYD enjoys a significant advantage in terms of production costs. This allows the company to offer competitive pricing without necessarily sacrificing profitability. However, BYD's aggressive discounting strategy could also trigger a price war in the Chinese EV market. If other manufacturers follow suit, it could lead to downward pressure on prices across the industry, potentially impacting profitability for all players involved. The coming months will reveal how these price cuts will impact BYD's sales and market share. The company is betting on its strong brand recognition, extensive dealer network, and cost advantages to emerge as a winner in this price war. China, the EV Battleground Heats Up. The significance of these price cuts by Tesla and BYD cannot be overstated, particularly in the context of the Chinese EV market. China is the world's largest and fastest-growing market for electric vehicles, accounting for more than half of global EV sales. This makes China a crucial battleground for any automaker with global EV ambitions. Chinese consumers have embraced EVs with open arms, driven by a combination of factors, including government subsidies, a desire for reduced air pollution, and the appeal of cutting-edge technology. This has created a dynamic and highly competitive EV market in China, with both domestic and foreign manufacturers vying for a piece of the pie. The price cuts by Tesla and BYD are a testament to the intensifying competition in this market. Both companies recognize the importance of securing a strong foothold in China to achieve long-term success in the global EV race. The discounts are a clear signal that they are willing to sacrifice some short-term profitability to gain market share and establish themselves as dominant players. The outcome of this price war in China will have far-reaching implications for the global EV industry. The Chinese market's sheer size and growth potential mean that any shifts in market share here will reverberate across the world. Automakers that can crack the code in China will be well positioned to lead the global EV revolution. Profit margins versus market share, a delicate balance. The aggressive discounting strategies employed by both Tesla and BYD present a classic dilemma for businesses, balancing profit margins with market share growth. On the one hand, lowering prices can lead to increased sales volume, allowing companies to capture a larger portion of the market and potentially benefit from economies of scale. On the other hand, price cuts can erode profit margins, especially if they are not accompanied by corresponding reductions in production costs. This can be particularly concerning for companies like Tesla, which have enjoyed relatively high profit margins compared to traditional automakers. The key for both Tesla and BYD will be to find the sweet spot where they can stimulate demand and gain market share without significantly impacting their profitability. This will require careful cost management, efficient production processes, and a deep understanding of consumer price sensitivity. Furthermore, both companies will need to be mindful of the potential long-term consequences of engaging in a protracted price war. While short-term discounts can be effective in boosting sales, sustained price wars can create an environment where consumers become accustomed to lower prices, making it difficult to raise them in the future. Navigating this delicate balance will be crucial for both Tesla and BYD as they navigate the increasingly competitive EV market. The decisions they make in the coming months will have a significant impact on their long-term profitability and their ability to maintain their positions as leaders in the EV revolution. Wall Street watches investor sentiment in flux. The recent price cuts by Tesla and BYD have sent ripples through the investment community, with analysts and investors closely scrutinizing their potential impact on the company's stock performance. Initially, the news of discounts was met with mixed reactions, reflecting the uncertainty surrounding the long-term implications of these aggressive pricing strategies. Some investors expressed concerns that the price cuts could signal a potential erosion of profit margins, leading to lower earnings per share and potentially impacting future growth prospects. This sentiment was particularly evident among Tesla investors, who have become accustomed to the company's industry-leading margins. However, other investors viewed the price cuts as a strategic move to stimulate demand in a slowing global economy and maintain market share in the face of intensifying competition. They argued that the long-term benefits of securing a dominant position in the rapidly growing EV market outweigh the short-term risks to profit margins. The stock market's reaction to the price cuts has been volatile, with share prices of both Tesla and BYD experiencing fluctuations as investors grapple with the potential implications of this evolving pricing environment. Ultimately, the long-term impact on stock performance will depend on the company's ability to execute their respective strategies effectively. Investors will be closely watching key metrics such as sales volumes, profit margins, and market share in the coming quarters to assess the effectiveness of these pricing strategies. The company's ability to articulate a clear and compelling narrative around their long-term vision and profitability targets will be crucial in shaping investor sentiment and ultimately driving stock performance.